Hi, everyone, and welcome to this pilot webinar, a holistic guide to tax season. The end of the fiscal year can bring up a lot of complicated financial and tax situations. Who should get a 1099? Do I owe city-specific taxes? When do I need to file with the state? As a high-growth business owner, this time of year is already extremely busy. You're evaluating how your business did this year, planning for the next year, and navigating your peak holiday sales. One thing nobody looks forward to is handling financial and tax obligations. In the next few minutes, we're going to share our best practices around managing your yearly close, 1099s, tax filings, sales tax, as well as R&D tax credits. I want to give a quick shout out to the TaxValet and Boast.ai, who have graciously offered their time to talk about sales tax and R&D tax credits as well. Before we begin, I must point out that this webinar has been prepared for informational purposes only. It's not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax preparer, legal, and accounting advisors before engaging in any transaction. If you already have a pilot bookkeeping or tax subscription, please talk to the specific account manager or tax preparer that's assigned to your account for advice that's tailored to your business. So here's our agenda for today. We'll start with some quick introductions of our star-studded panel, followed by best practices around each of the 4 topics listed here: closing your books, income tax, sales tax, and R&D tax credits. I encourage you to post your questions in the Q&A section of the Zoom webinar. As you have them, we'll reserve the last 10 minutes to address any and all questions. We're also recording this webinar, and we'll share the recording in the coming days with everyone who attended. So let's move on to introductions. I am Pranav. I am a product manager here at Pilot, and let me introduce you to our panel for today. Ashley Schagrin is the head of product operations for Pilot. She's amongst one of the earliest employees at Pilot and has set the foundation for our bookkeeping service. She has tons of experience with both high-growth startups, most recently having worked at Dropbox in its pre-IPO days, as well as an audit with one of the big 4 firms at KPMG. She's also a certified public accountant. Alex Reutenberg is a New York-based CPA and a distinguished member of our Pilot tax team. Over the last 15 years, he has worked for Wall Street and public accounting firms such as Morgan Stanley, Goldman Sachs, PwC, and Marshall Wace. Alex has helped several Pilot customers with their tax filings and covers a wide spectrum of customers from high-tech startups to e-commerce businesses and also smaller single-member LLCs. Alex Oxford, other than being the second Alex on this panel, is also the founder of the TaxValet, a solution that helps you eliminate the hassle and risk of sales tax by doing it for you. Alex started off in the technology and e-commerce industries with companies like Equifax, Sovos, and CleverPet, and ultimately found his passion for solving the pain of sales tax. He founded the TaxValet in Feb 2018 and has signed up hundreds of customers in a short period of time and are handling hundreds of filings every month and quarter. Lastly, but definitely not the least, Lloyed Lobo is a co-founder and the chief strategy officer for Boast.ai, a solution that helps businesses recover their research and development costs from various government programs that offer those types of incentives. Lloyd has led product sales and marketing at various tech startups, been a venture partner with Plug and Play Tech Center, and has also co-founded the Traction Conference, a popular startup-focused event. Boast.ai has experience with filing and successfully obtaining R&D tax credits for hundreds of startups across a variety of industries. So thank you to the panel for chatting with our audience today. Let's kick this off with Ashley.
Great. I'm really happy to be here speaking to all of you. To dig right in, so closing the books. First thing first, actually, before closing the books, is making sure that you have set up your business for success. So what this looks like and some of the best and easiest things that you can do for yourself and for your business are things like setting up bank and credit card accounts that are different and separate from your personal accounts, and really making sure that you're using them for business expenses only. Using a payroll provider to pay your employees to ensure that the proper payroll taxes are remitted. And also using an expense reimbursement system to track employee reimbursements. Using something like Expensify is inexpensive and is a great tool for tracking reimbursements, as well as making sure that you pay out the appropriate amount to your employees on time. You'll also then want to engage with a bookkeeper or accountant to prepare your monthly financials. Having an expert work on these for you will give you peace of mind and free up time you may have spent reconciling account balances or slogging through transaction level details to focus on your core business instead. So that brings us to closing the books. So as part of your monthly close process, your provider will do things like reconcile your bank and credit card accounts on your books back to the original statements, reconcile your payroll entries against your payroll system, reconcile other asset and liability accounts. They'll classify all of your bank and credit card transactions to the right account, which can be very time consuming depending on what your transaction volume looks like. They'll also record prepaid expenses. So that means that if you purchased like a 12-month subscription to something, such as LinkedIn, for example, it is recognized evenly over the service period. They'll identify assets to be capitalized and then depreciated on your books. So for example, if you purchase some computers that are over your capitalization threshold, those will show up as fixed assets on your books. They'll also recognize revenue, so work with you in understanding what the proper treatment may be depending on your business. They'll also assess and sort of check in on overdue accounts receivable and accounts payable balances. So accounts receivable being money that your customers owe to you, and accounts payable being money that you still owe to your vendors. They will identify any variances that they'd like to look into on your P&L to make sure that everything sort of makes sense and that we're not missing any expenses or double counting something. And then they'll also check in with you on any open questions or highlight anything unusual that they noted in the period. Additionally, at the end of the year, if your financials are prepared on an accrual basis, your provider will check in with you about expenses that were incurred but not yet paid during the fiscal year because they'll want to record accruals for those expenses. They will also likely perform other procedures on their own, such as scanning your bank registers in January to check to see whether they can identify any of these expenses that they might like to ask you about themselves. So once your books for the year have been prepared and sort of all outstanding questions have been answered, your provider can then sort of formally close your books to then be sent off to your tax preparer. It's pretty important to have a hard cutoff period here when you've determined that everything is final. Your bookkeeper or accountant will want to send these over, and if your tax preparer charges you hourly, you'll incur additional cost if you request that your accountant or bookkeeper continues to make adjustments and then have to send revisions and adjustments back over to the tax preparer, and then the tax preparer will have to make adjustments to their return that they've drafted. So additionally, once the books are final for the year, you can also feel good about sharing your numbers with the board or other investors. You can then compare numbers to any budgets that you might have been tracking against and also use these final numbers for future planning and forecasting. The next thing to note is that you want the process to start early. You really don't want to be, in March, searching around for a bookkeeper and a tax preparer to work with for, the financials from the prior year. Really, you want to engage with them early. You want to have monthly financials prepared in a timely manner. So in the month following the prior month close, your bookkeeper or accountant should be checking in with you regularly when they have open questions, and you'll want to make sure that you resolve open items monthly so that they don't sort of stack up all at once at the end of the year. We really want to make sure that you're able to file your taxes well ahead of the deadline to sort of eliminate any last minute stresses or headache that you might feel because of a compressed timeline. And in addition to your normal monthly close processes, your bookkeeper or accountant may also perform an end of year type review process as another final check for accuracy and completeness, and will reach out to you to resolve any lingering or open questions. So what this mostly looks like is sort of taking a more holistic view of your financials for the year to make sure that everything really makes sense and that we feel good that we have captured all of the transactions that we need to have captured and have asked all of the questions that we needed to ask. Some other important considerations here. So your financials could be prepared cash basis or accrual basis. So cash basis books are books that reflect revenue as money is received and expenses as cash is paid. It's really just following the movement of cash. So accrual basis books, which is what Pilot prepares, actually focuses on matching revenue to the period in which it is earned and expenses to the period in which they were incurred. So a good example of this is just a software subscription, for example. So if you are a SaaS business and you sell annual subscriptions, you would want to recognize the revenue that you have received over 12 months. You want to recognize it over the period that you've earned it. And then similarly, as we talked about a little earlier, if you're purchasing an annual software subscription, you'd want to recognize that expense over 12 months. Accrual basis financials really provide a more accurate view of your business. And this is one benefit to having accrual basis financials prepared over cash basis. Additionally, another important consideration during the year, so if you've had a change in your bookkeeper or accountant or system, you'll want to make sure that you connect the two. So if possible, that your new bookkeeper and your previous provider get together so that your new provider can get an understanding of what's on your balance sheet to make sure that they have a clean set of financials moving forward. So they'll often ask for things like supporting schedules or other documents to help them make sure that they understand what is included in each account balance, so that, like I said, you have a clean set of financials, everything makes sense. There aren't sort of items or transactions lingering there that, should have long been written off or are no longer relevant. And then additionally, if you're thinking about fundraising, you'll definitely need a set of financials to share with potential investors. So most of the time, they'll also want accrual basis books, which we talked about a little earlier, and is another reason why you would potentially want to see accrual basis financials rather than cash.
Great. Thank you so much, Ashley. Let's welcome Alex Reutenberg, who's going to lead us through the next section about income taxes.
Thank you, Pranav, and good morning to everybody on the West Coast, and good afternoon to everybody on the East Coast. So income taxes is a hot topic. For everybody. Unfortunately, we all have to pay taxes. Income taxes is something that needs to be taken care of and has to be filed for everybody. A lot of people first take a look into that it's the federal income taxes, but in actuality, there's a lot more that needs to be filed. Obviously, federal income taxes are taken care of. We then have informational reporting, which would cover forms like 1099 and other informational forms where it's information about the owners or shareholders of the company. We then have foreign activity related reporting to the IRS, whether it's ownership in other companies that are owned by the US parent, where you might have a foreign interest in, or if a foreign individual owns a portion of the US company. So that is foreign activity that would need to be disclosed to the IRS. The next thing that would need to be looked at is state and local income taxes. There is different types of taxes within different states. So the usual one that everybody's aware of is income taxes. Then there is also franchise taxes. A very common one is in the state of Delaware. Gross income taxes, which are very common in the state of Washington. And then a multitude of other states have privilege taxes or minimum taxes. State of New York or the state of California are examples of that. Now, if we look at, we have the population of different types of taxes that we need to file. The other big question is, where do we need to file? And anybody who's incorporated in the US would need to file an IRS tax return. The next topic is, where do we file based on the states? And there's a couple of different thresholds or reasons why you would have to file in a state. So the very first one and simple one is physical nexus. Nexus being a connection to a state. Physical for reasons of whether you have an employee there, a contractor there, or perhaps you have a warehouse or an office. Economic nexus is as a result of a connection for financial reasons that you have to the state. And what this has basically said is that you no longer have to have a physical connection to the state in order for the state to be able to tax your transactions or activity. So the economic nexus for certain states have different thresholds. Some of the states will have thresholds of, let's say, $500,000, like the state of California. Other states will have thresholds as low as $10,000. So depending on how much you transact in a particular state and sell into a particular state, that will dictate the whether or not you have economic nexus. The next reason somebody might or a company might have a connection to a state is because they're registered to do business in a state. So if you've gone ahead and registered as a foreign entity in a particular state, so let's say you have an employee in Louisiana, and you've registered to have them as an employee there, and they move out of the state of Louisiana, but you still maintain registration in that state, you would still continue to have to pay taxes, or at least file a tax return in that state. The next one would be for if you have an investor or partner within that state. Certain states, perfect example of this would be state of New Jersey. So if you are a partnership with a partner who is a resident of New Jersey, and you can be completely operating only in the state of California, you would still need to file a New Jersey tax return because New Jersey has a residency filing requirement. The next one would be licensed by a state. So if you're in an industry which requires you to have a license, whether you're a general contractor, an insurance company, or anything else that requires you to be licensed to do business in that state, even if you don't have anybody physically sitting in that state, you would still be required in many cases to file taxes in that state. Perfect example is that if you're a insurance agent with clients in North Dakota and you're licensed by the state of North Dakota, you may be required to file a North Dakota tax return. So that is the different types of nexus connections to a particular state that you might need to do. Now, if you're getting to a point in the tax compliance year where you don't have enough time to file or figure out all the states that you need to file in, what you can do is you can file for an extension. General rule, you get an additional 6 months to file a return. So if you are a partnership or an S Corp, which generally has a March 15th deadline for a calendar year entity, you'll get an additional 6 months. So that return will now be due September 15th. And if you're a C Corp and your original tax date is due on April 15th, and you get a 6-month extension, it will now be due October 15th. One extremely, extremely important thing to remember is that an extension is an extension to file, not an extension to pay. So if you have a minimum tax due, like the state of California has the $800 fee for LLCs or any other minimum taxes that you might have, you still need to pay that amount of money when it's due during the year, or at least by the due date, which is March 15th or April 15th. If you pay after March 15th or April 15th, you will most likely result in fines, penalties, and interest because the payment is deemed to be late. And now the other item that we wanted to discuss today was the informational filings. The very first one that a lot of people are very common with is a 1099 miscellaneous. And what the 1099 miscellaneous form is for is to report to the IRS, similar to how you do end of year reporting to the IRS for your employees and W-2s. You need to do end of year reporting to the IRS for your consultants. And they require this to be done via 1099 miscellaneous. The individuals or companies that are supposed to receive it include anybody who's paid over $600, as long as they are not a C Corp or an S Corp, or if they're lawyers or doctors. Can't really tell you exactly why lawyers and doctors are perhaps not exactly trusted. And even if they're paid $100, they'll still need to be receiving a 1099, but that's the requirement of the IRS. And then also a very large reminder on this. The due date is January 31st of the following year. So for 2019 activity, the due date will be January 31st, 2020. Any forms that are late will be charged starting at $25. Late fees per month per form. So if you have 10 vendors, that's $250. And the fees can go up as high as $625. So this covers a very high level review of income taxes reporting that's necessary, extensions, as well as 1099 informational reporting. I'll hand this back to Pranav.
Thank you, Alex. I want to welcome our next speaker, Alex Oxford from the TaxValet, to cover sales tax.
Hi, everyone. I am Alex number 2, Alex Oxford, to talk about another highly fascinating topic, sales tax. Let's talk about what sales tax is, though, at a bird's eye view. Sales tax is, as you know, a tax that is charged at the state level when a taxable product or service is exchanged for something of value. So there's a couple of loaded phrases there. Keywords here are taxable product or service. You might be selling accounting services or janitorial services or software services or software as a service, SaaS, for example. There are a whole bunch of services that individual states might consider taxable, and as well as tangible personal property. So sales tax is due if you're selling a taxable product or service and you're exchanging it for something of value. So if you're giving away services for free in exchange for something else, sales tax could also be due. But you only have to pay sales tax if you have what's referred to as sales tax nexus. Now, Alex was just talking about income tax nexus, and I want to drive the point home that income tax nexus and sales tax nexus are very similar to one another, but they are not the same thing. And we'll talk about this in a few more minutes. But there are a whole bunch of ways that you can get sales tax nexus, physical presence being the easiest, having people, property, inventory, and also crossing economic nexus thresholds. And most importantly, when you owe sales tax, you are supposed to collect the sales tax from your customers and remit it to the state. So this is why you might hear sales tax referred to as a trust tax. You are getting a sales tax permit from the state that gives you the authority and permission and responsibility, so it's a big task, to collect the sales tax from the customers on behalf of the state, hold on to it, and then pay it to the state when it's due. So when looking at how to tune up your sales tax and make sure that you are complying to the best of your abilities at the end of the year, here's a couple of tips to make sure that you at the very least are aware of what your liabilities are and what action you're supposed to take. So the first thing I would do is first determine where you have sales tax nexus. You only owe sales tax in a state if you have sales tax nexus or if you have a permit in the state already. So there are a whole bunch of ways that you can get sales tax nexus, but the two most common are going to be through physical presence, people, property, inventory, leasing, renting, owning property, and also economic nexus. So this goes back to the 2018 Wayfair decision. I won't bore you with the details, but it was a Supreme Court ruling between Wayfair and South Dakota that ultimately resulted in the foundation of sales tax law in the US being completely changed. And we've seen almost every single state in the United States release some version of economic nexus. Now, the thresholds vary per state. The most common threshold is $100,000 in sales or 200 transactions. It's very easy to cross that transaction count threshold if you're selling a very low cost item. So the first thing I would do if I were in your shoes is just figure out, do you have sales tax nexus in any state outside of your home state? Because if you do, you could be accruing sales tax liabilities without even realizing it. The second thing I would do is figure out, are the products or services that you're selling even taxable? Do you need to be concerned with this? Because you might be selling a service that you're assuming is not taxable and it actually is, or you might be selling a product, let's say supplements or clothing, where they're not taxed in certain states. So that's a huge consideration. Third thing, once you know how your products are taxed and where you're supposed to be collecting sales tax, where you have sales tax nexus, I would then try to figure out what your sales tax exposure in the states is today and also moving forward and also retroactively. If you realize oh my gosh, I hired an employee or a contractor in California 2 years ago, and it totally slipped our mind and we didn't get a permit. It's really helpful to know what your historical exposure is. So at the very least, you can begin preparing for the unfortunate event of you being audited, which is what we're trying to avoid, right? It's all about risk management and exposure. How do we protect the business in the event of an audit? All of these things, by the way, is something that our business, TaxValet, can help you with. We can walk you through this process step by step. Once you've figured out where you have exposure and you've determined where it is you want to get permits, next you need to get set up to get sales tax permits. It's pretty straightforward. Well, it's not as straightforward as it should be. There's a lot of different forms you need to fill out, but you get your sales tax permit and then begin collecting tax from your customers, taking into account any sort of product exemptions. And lastly, you need to make sure that you're filing sales tax returns in any of the states, any of those new states that you got permits in. If there's one takeaway that you have from this presentation right now, it would be please check to make sure that you are aware of where you have sales tax liabilities outside of your home state, particularly because of economic nexus, because of the Wayfair ruling in 2018. That's the most important thing I hope you take away from this. So what are your options with respect to sales tax? There's really three different options for you. You can either do it yourself, you can hire an accountant or try to have an accountant do it internally, or have someone manage it for you. If you're doing it yourself, there's a variety of software and tools out there that you can use. One thing to keep in mind is that these are just tools. It's like being given a hammer, but you still have to know how to build the house. So if you're exceptionally fascinated by sales tax, which I happen to be, then this is something that you can do yourself, but just keep in mind that it's going to take a lot of time and it's fraught with potential risks of making the wrong decision. Hiring is usually out of reach to many small, mid-sized businesses because they don't have the budget to hire their own sales tax department. And that's why we have this third option, which is hiring another firm to handle everything for you each month. And that's something that our company, TaxValet, can help you with. Thank you.
Thank you, Alex. And now moving on to the last section here before we go into Q&A, Lloyed Lobo from Boast.ai to talk about R&D tax credits.
Awesome. Thanks, Pranav, for having me. And I'm going to get right into it. So if you haven't heard of the R&D tax credit program, each year the US government provides over $10 billion to 120,000 companies for developing new or improving existing technologies, products, materials, and so on under the R&D tax credit program. It's essentially a general business tax credit that's been in the tax law since 1981. And it's designed to give you designed to encourage innovation in the United States and put more money back in your pockets if you're doing R&D. So what is the benefit here? Like what can you get for it, right? So more or less what it works out to is about 10% tax credit from federal, and every state is different. So California state is 7.5%. Washington state has no R&D credit. So if you want to know what the R&D credit in your state is, just shoot me a question in the chat window. But essentially, you could get 10% of your R&D spend from federal and varying based on the state. Now, how can you use these R&D tax credits? If you are a company with less than 5 years of revenue from the tax year and less than 5 million in revenue in the tax year, then you can offset Social Security taxes and get a refund. So essentially, let's say you had $1 million in R&D spend, and so that's 10% is 100,000 in R&D credit, and you have 2 million in payroll. Now, your Social Security tax on a $2 million payroll is about $120,000. So that R&D credit of 10% you got on your R&D spend of $1 million, that is 100,000, can go to offset Social Security taxes for your entire company's payroll of 2 million. So you've paid about, you're owing about 120,000 in Social Security taxes in a year. You'll get a refund from the IRS for about 100. And that assumes you've had revenues for less than 5 years from the tax year, and your revenue for the tax year is less than 5 million. The other way, say you're not in that criteria, once you hit more than 5 million in revenue, or you've had revenues for more than 5 years from the tax year, then you can use it to offset income taxes, assuming you are profitable. And if neither is the case, then you can carry forward these tax credits. Federally, you can carry it for 20 years. In California, it's indefinitely you can carry them forward, and then every state is different. But those are the three options you can use the R&D tax credits for. So how do you qualify for this? What is the process to qualify? So you need to qualify for it, you need to pass a four-part test. Now, most people, they'll say, oh, we'll apply for it and let's see what happens. Or my accountant filed for it by just filling out a form and claimed 100% or 80% of my R&D expenses. And then what happens is the IRS may not audit you in year 1 or 2, but 4 or 5 years down the road, the IRS will audit you for the R&D tax credit, and they want to see documentation for all those years that you claim R&D credits to support that the work you're doing meets their criteria. So what is their criteria? They have a 4-part test to be eligible. The first criteria is permitted purpose, meaning the work must be done to develop a new or improved product or process. Fairly simple. The second is eliminating technological uncertainty. So what that really means is you're en route to this development effort, you were faced with some technological uncertainty, and you couldn't find information in the public domain to address that. So for example, there was no open API, there was no open code, there was nothing out there in the public domain to solve this uncertainty. And so that's the second criteria, is you should have faced technological uncertainty that can't be resolved with publicly available information. The third is process of experimentation. So the work must be done in a systematic process to evaluate one or more alternatives to overcome these uncertainties. So you've gone through, you come up with a hypothesis, you face this challenge, you research the public domain, there's no solution, and then you work through your hypothesis, you iterate and get to the end outcome. Success or failure doesn't matter. It doesn't matter if the competitor across the street is doing it, they're not sharing that with you. What matters is you face the technological challenge and you work through an iterative process to get to the end outcome. So one example might be on the low end, say you're integrating with a third-party system and it's a legacy manufacturing system. The company that they bought the software from doesn't exist anymore. And now you got to connect your software with that manufacturing system to make the two systems talk. But there's no documentation, there's no API, there's nothing. So there's a lot of uncertainty there. And you got to write the protocol for the two systems to talk from scratch. And that's on the low end, basic, simple stuff, but there's R&D because there's technological uncertainty, and it likely doesn't get resolved in the first go around where you write a protocol and they're communicating at 100%. On the high end, or highly innovative rather, is you may be writing algorithms, artificial intelligence algorithms to parse through different types of data, voice, video, text. You're gathering this data, normalizing it, and trying to pull out real-time insight from different types of data using machine learning. And there's always uncertainty when there's technological uncertainty when there's more than one variable. So at the end of the day, as long as there's technological uncertainty and the answer is not in the public domain, and you need to work through iterations to get to the end outcome, you can qualify for these R&D tax credits. And the last criteria is technological in nature, which is fairly simple. The work must be within the physical, biological sciences, engineering, or computer science. So really the questions you want to ask yourself is, have you created a new product? Have you made improvements? Have you added new features? Have you done integrations? Have you changed processes to reduce costs? Generally, if you're developing new technology or improving existing technology, there's money to be had there. What can you claim? So you can claim your salaries, US employee salaries that are W-2s. You can claim contractors, provided those contractors are in the US. You can claim patent costs. You can claim hosting costs and materials. Materials are classified as materials consumed in R&D. Typically, software companies won't have it, but let's say you're a hardware company or you're building drones or whatever have you, then you're using materials to build your first prototype, and those materials often get discarded or just used in prototyping. Those are the materials you can claim. And again, it's about 10%. So let's say all of this aggregates to about $1 million. 10% from federal is 100,000. That's what will go towards offsetting your Social Security taxes. And then 7.5% from California state. If you're in California, that's about 75,000. That won't go towards Social Security tax, but that can go towards state taxes in California. When is this filed? It's filed with your corporate taxes. So if you're a C Corp, your deadline is April 15th, or if you filed an extension is October 15th. I want to point that if you qualify for the payroll offset, meaning you're less than 5 years in revenue and less than 5 million in revenue in the tax year, then rather than waiting for April 15th, I recommend filing by end of March, because you can apply to use the R&D credits to offset payroll taxes in the quarter that follows the filing. So let's say instead of waiting for April 15th, you file your R&D tax credit form with your taxes by end of March, then you can start offsetting payroll taxes in Q2 of next year. But if you wait for April 15th, that is already in Q2, and you file, then the first opportunity to offset payroll taxes is for Q3. And that's how it works. I would stay on top of it. In terms of recommended process, as I mentioned, the IRS has a tendency to audit these. R&D tax credit made the IRS's dirty dozen of tax scams. So make sure you're documenting things. If you're claiming R&D, you're documenting how it qualifies and meets that 4-part test. Over to the next one, what are your options? So you can either do it yourself. As I said, if you're doing it yourself, you need to, the process involved is you need to document all the work you're doing and how it meets the IRS's 4-part test. You need to time track everything as it relates to that 4-part test, fill out the tax forms, and then every quarter you need to offset your payroll taxes and fill out a separate set of forms. Or you can outsource it to R&D tax experts like ourselves using software and R&D tax specialists on the team. What we'll do is we'll help you figure out what works qualifies and what expenses qualify. We'll essentially take a couple hours from you and handle the whole process from end to end, making sure everything is claimed, it meets the criteria. If there's an audit, we'll defend you in the audit, and we'll handle the quarterly payroll offset for you and make sure you get that refund. And that's all I had.
Fantastic. Thank you, Lloyd. And that gets us to the last section of this webinar, which is all about the questions that you have posted. So I'm going to go ahead and read off some of the questions that we have seen and asked one of the panelists to answer each of them. So the first question that we had around state taxes was, if you maintain virtual offices in, let's say, California and New Jersey only for local presence but no operations, for example, only for branding purposes or marketing purposes, does the business have to file a return in California and New Jersey? And I think, Alex Reutenberg, maybe you can take this question.
Sure thing. On an overall basis, I hate to give this answer, but it slightly depends. It depends on how the agreement and virtual office is stated. If it simply says that you have the ability to use the addresses of somebody without actually being assigned a particular location, then you should be free and clear from having to file taxes in that state. There are some verbiages that I've seen where they assign a specific location or a seat to a person. In that case, you technically have a position or a location in that state. It's also very much a question of where you need to or want to, where you need to file and what the risks are by not filing for simply a virtual office. There's also a question of, if you have a virtual office in California and New Jersey, do you also have other factors like sales in that state or travel to that state, which will be a possible reason for you to have Nexus as well.
All right. The next question we had was, what happens if we haven't collected sales tax? And I think Alex Oxford, maybe you can chime in on that.
Sure. So if you haven't been collecting sales tax in a state where you have sales tax nexus and you triggered nexus in the past, so that's just a long-winded way of saying that you owe sales tax retroactively, you have a couple of options. The most complicated, but also potentially the most money-saving option is to do what's called a voluntary disclosure agreement with the state. And this is where a third party like TaxValet, for example, would go to the state and say, hey, state, we have a client. They have been accruing sales tax liabilities and they want to come clean. Can they pay the back tax? And in return for being cooperative, you give us some discount on the penalties and interest. And generally what we'll see is that some portion of the penalties and interest will then be taken off. We don't see the states giving a lot of flexibility with the back taxes, like the original sales tax liability being pulled out of the equation. The reason why this is the most complicated is because it's time consuming and there's a lot of back and forth with the states. It can take 2 or 3 months. The next option is just getting a permit using that correct permit start date and paying the back tax plus the penalties and interest. The advantage to this is that you don't have to waste a whole lot of time or really pay a service person to go out and negotiate with the state on your behalf. You're going to be spending more money on the penalties and interest. The third option, which I don't advise, but is just to ignore it if it's immaterial. So if you only owe $5 retroactively and you decide that's a risk that you're comfortable with taking and you don't want to pay and you want to ignore the state, then as the business owner, that's your judgment call to make. Not one that I would ever recommend, but materiality of the liability is something that you should consider.
Okay, the next question. Most of our customers are from different countries, so most of our business is outside of the US while we are headquartered in the US. How would paying taxes work for us? I think, again, Alex Rittenberg, maybe you're best positioned to answer that one.
Sure, thanks. So this, the general answer is it depends. What we would need to do is to sit down and take a look at and do a nexus study. What that will do is take into account where are you located, where are your employees, where are your contractors, where are your clients. And based on that information, we would then be able to take a look and see, okay, you're in 15 out of the 50 states. There's also a possibility that you might have a filing obligations in, let's say, the UK or somewhere in Europe. Take a look at the exposure, see what the risks are, and then make a decision as to where to file and when to file, and then move forward from there. One thing that is very important to do is to have an ongoing dialogue with your service provider to make sure that you do things appropriately. There's also a possibility that you might be doing business in a particular state without having the authority to do business in that state. And that can actually cause even more issues other than just tax compliance and having to file tax returns that might be late because they were due during the year, not just simply after the year end.
All right, we have a couple of questions about 1099. So I'll direct both of these to Alex again, but here's the first one. If we have a contractor and they're submitting consulting fees as well as reimbursements, things like meals or office supplies, do we subtract those reimbursements from the 1099 amount, or does the contractor subtract out those reimbursements? That's number one. The second is we are an e-commerce company and sometimes an inventory vendor will charge us for samples. Do we need to send a 1099 to those vendors for the amount of those samples? Alex?
Sure, thanks. So the first one is gross or net of the expenses that are paid or reimbursed for the contractor. My usual rule of thumb with that is to show the gross amount. So if the person invoiced for $10,000 and had $200 worth of reimbursements, I would provide a 1099 for 10,200 because that is the amount the IRS is expecting. And then the individual is able to show 10,200 of gross income with expenses of 200 and then go from there. So that they won't be overcharged on taxes. There's no over allotment of any taxes onto them. And then also on the company side, because it is a reimbursement, we want to make sure that we're able to capture the expense as well and take it as an expense on our side. The second question was with respect to whether or not to issue a 1099 for a sample. The 1099s are not simply issued for the final products or for services. The threshold of whether or not a 1099 needs to be issued has to do with thresholds of how much money was sent out to the individual or to the company, and then also the type of entity that they are. So if they're a partnership or an LLC and they sent you samples for $2,000 worth, you ended up going with a different vendor, you would still need to send them a 1099 for $2,000.
All right, sorry about the interruption on the last one, but we have a couple of questions here on the R&D tax credit side of things. I'm going to direct these to you, Lloyd. The first question is R&D tax credit only for hardware companies? The second was if R&D tax credit work if your R&D employees are outside the US. And the third one was there is a skincare incubator company. Would the R&D tax credit apply to any costs to develop those skincare products?
Yeah, so the first one is R&D tax credits apply to any company that's building new products or improving existing products and technologies. It doesn't matter your hardware, software. We have clients in agriculture and manufacturing and pharmaceutical, healthcare, all over. It's not the white lab coat kind, it's applied R&D. So the bulk of our clients, like 60% or more, end up being software companies. So you don't have to be in hardware. You can be in software. You can be in pretty much any industry, from like food to agriculture. There's R&D there. Does R&D credits work if your R&D employees are outside the US? No, unfortunately, the program exists to encourage innovation in the US and economic growth here. So they will give you that credit if your salaries and subcontractor costs and all expenses are in the US. You can claim foreign employees. The last one was the skincare incubator. So if you're doing any formulation or building any formulations as such that you face challenges with and you had to go through iterations to get to the end outcome, then yeah, you would likely qualify, right? So you modified product formulations, and you tried different things for maybe this longevity, whether that's a certain look or feel, packaging. There's various amount of things that could go into there. Then you can definitely qualify there for the R&D credit.
I think we have one more R&D question for you, Lloyd. So can the offset only apply to employees or contractors or that are engineers, or does it apply to other members of the company?
Yeah, so you can, so there's two aspects here. You can claim only R&D spend, right? So that is R&D contractors, R&D W-2s. Now on your W-2, it depends on who's R&D, right? So it could be direct developers, project managers. Now as a CEO, if you're spending certain time of your R&D and you can prove it, then you can claim that person's time. So once you have the technological challenge, anyone who's spending time on it, whether that's QA, whether that's testing, whether that's technical requirements gathering, whether that's technical analysis, whether that's project management, you can claim portions of their time. Now, whatever the R&D credit is on the R&D spend. Once you get the credit, it can be applied to offset Social Security taxes for the entire company's payroll. And you only pay Social Security taxes on payroll. You don't pay it on contractors. So R&D credit is on anyone who's involved in R&D. It's their spend. And not only that, so it's like W-2s, it's contractors, it's hosting costs, it's materials, and so on, patents, and so on. whatever credit you get there can go towards offsetting Social Security taxes for your entire company's payroll. So if you got 100,000 from R&D credits, it can go towards all of your company's Social Security taxes. So let's say you have, I don't know, 4 million in payroll, and your Social Security tax is about like 240, 250,000. That 100,000 in R&D credit from just your engineering spend will go towards offsetting that $250,000 in entire company payroll. So tax, Social Security tax. I hope I explained.
All right, we have the last couple of questions here before we end. The penultimate question is, for a single member LLC who has elected to file as an S Corp, pre-launch, so no employees on payroll yet, what sort of tax filings are due and when? This might become a longer conversation, so we'll follow up over email with a blog post that lists out the most important deadlines to be aware of. It's on the Pilot blog. If you are interested in just searching for that on Google, you'll find it. Otherwise, we'll send it over email. And then the last question here is, if you can state in a few short steps, what should someone who's starting a brand new business do first regarding bookkeeping and taxes? And that's a fantastic question. We get this all the time from startups and small businesses. And really the big thing to do here is to get a reliable, high quality bookkeeping and tax firm to help you from the very get-go of setting up your financial back office and infrastructure, to starting to prepare your financial statements on a monthly and annual basis, and then to handle all your tax filings. You really don't want to be spending time and energy learning how to do these things. Instead, you should be spending time on building your business and bring in the experts to put your bookkeeping and taxes on autopilot. All right, so that brings us to a close here of our holistic guide to the tax season. Thank you to all the audience members for joining and the panelists for spending this time with us. We'll send out the recording over the next few days and some follow-up material over email. Thank you all.